Hey there, welcome back to the channel. Today, we're going to dive into a topic that affects many of us on a daily basis: credit. Now, credit is a concept that can be a bit confusing, but it's important to understand because it impacts a lot of aspects of our lives. In this video, we'll explore the different types of credit that exist, so let's get started. First, let's talk about the most common type of credit: revolving credit. This type of credit allows you to borrow money up to a certain limit, and you have the flexibility to repay it over time. Credit cards are a prime example of revolving credit. You can use your credit card to make purchases, and each month, you have the option to pay off the full balance or just make a minimum payment. However, keep in mind that if you only make the minimum payment, you'll accrue interest on the remaining balance. Next up, we have installment credit. With installment credit, you borrow a specific amount of money for a particular purpose, such as buying a car, home, or even financing a vacation. Unlike revolving credit, installment credit has a fixed repayment term. This means you have to make regular payments over a set period of time, typically in equal amounts. A common example of installment credit is a car loan where you make monthly payments until the loan is fully repaid. Another type of credit worth mentioning is secured credit. Secured credit requires you to provide collateral, which is an asset that the lender can seize if you fail to repay the loan. This collateral gives the lender a sense of security, hence the name secured credit. A common example of secured credit is a mortgage loan. When you take out a mortgage to buy a home, the house serves as collateral. This type of credit is usually easier to obtain and may have lower interest rates compared to unsecured credit because the lender has a form of guarantee. On the flip side, we have unsecured credit. Unsecured credit doesn't require any collateral, making it riskier for lenders. Since there's no asset backing the loan, the lender relies solely on your creditworthiness to approve your application. Credit cards and personal loans are typical examples of unsecured credit. It's important to note that unsecured credit often comes with higher interest rates to compensate for the increased risk taken by the lender. Now, let's talk about a type of credit that most people are familiar with: student loans. Student loans are a form of credit specifically designed to help students finance their education. These loans can come from private lenders or government programs. What sets student loans apart is that they typically have lower interest rates compared to other forms of credit. Additionally, in some cases, the repayment of these loans can be deferred until after you finish your education or once you start earning a certain income. Moving on, let's touch on a lesser-known type of credit: a line of credit. A line of credit is a flexible form of borrowing that gives you access to a certain amount of funds that you can use as needed. It's similar to a credit card but often with a lower interest rate. With a line of credit, you only pay interest on the amount you borrow, and as you repay the borrowed amount, that credit becomes available to you again. It's a useful tool for unexpected expenses or when you need some extra financial cushion. Last but not least, we have merchant credit. Merchant credit is a specific type of credit provided by stores or retailers. It allows customers to make purchases on credit directly at the store. Now, while this may sound tempting, keep in mind that merchant credit often comes with higher interest rates compared to other forms of credit. It's important to carefully consider the terms and conditions and make sure it aligns with your financial goals before opting for this type of credit. Phew, that was a lot of information to digest, but I hope this video shed some light on the different types of credit that exist. Remember, credit can be a powerful tool if used responsibly, but it can also quickly become a burden if not managed properly. So, be sure to educate yourself,